Hello, everyone. Welcome to Kryptonized. Today, we're going to do something that's a little bit different, and that is talk about taxes within crypto. You know, tax season's coming up in April, unless they delay it again. So we want to talk about what you need to know. Maybe Micah has some tax strategies for us so that we could pay less tax as a result of any crypto trading that we've done or crypto earnings that we've obtained. But with that, and before we start, let me turn it over. Michael, will you introduce yourself and give us a little bit of background?
Sure. Try to keep this as brief as possible. My name's Micah Fraim, or CryptoTaxCPA.com. And before getting in, I've been in crypto for several years now. Before that, we really specialized in online businesses and people with really growth-centric companies that just had very dynamic, rapidly changing situations, which is a big part of what attracted me to crypto taxes, that blockchain moves very, very quickly. It's kind of the Wild West now in terms of there being very little guidance. So with that, it's a constant updating and changing landscape, which is tough for the taxpayers, but pretty exciting from my end.
My biggest issue from what I've seen with traders, and I'm not a heavy trader at all, but
Yeah,
is
me
that
neither.
they're moving between wallets, they're moving between exchanges, and to my knowledge, there's nothing that tracks all this to make sure, hey, I bought it at this, I traded at that, and I realized these returns but lost here, and it's in some cold storage wall. How in the world are you tracking all this stuff?
Oh, it's a nightmare. I mean, at the end of the day, it's just bad. There's things you can do to mitigate it, but unless you're trading on, I think it's probably like, unless you're trading through an actual brokerage company, you're not getting issued a 1099. So I think like Robinhood Crypto was one of the few, since it's under a securities firm, that actually issues you a bona fide 1099. Aside from that, if you're trading on a centralized exchange, Coinbase or they're required to keep track of some of that for you. But exactly to what you said, that only really works if you're only trading on one centralized exchange and that's all you're doing. Because if you're on DeFi, your SOL, and even if you're just trading on centralized exchanges, Binance isn't keeping track of what you bought on Coinbase. Or it's funny, I previously I would have been listing Voyager and these other places, but it's slowly we're getting fewer and fewer centralized exchanges to list. So it's rough is the first thing I'll say. The only thing you really can do is you have to use one of these specialized softwares like CoinTracker, like Coinly, Zenledger, something like that. And it's almost required that you use those, because especially if you've got 10 wallets or something, there's no way you can try and pull everything from Etherscan, but then you're trying to figure out what the value was as of the time, your holding period. It's an absolute nightmare. So those are helpful, but they get you about 90% of the way there. They still feel like they're in beta testing is the really unfortunate thing.
So what is the state of crypto tax reporting? What's the IRS expect? Where are we today in January?
It's pretty much on the taxpayer to keep track of it. Again, unless you're on a centralized exchange, they're responsible for some degree of tracking for what you're doing on their platform. So again, if you're just doing all your trading on Coinbase, you're fine. You've got a nice, easy to follow report from that. But aside from that, it's on you to do it. So that gets really difficult, again, not only because you've got to use the software and it only gets you 90% of the way there, but it really does feel like it's in beta testing, because those programs, and I know this isn't an easy thing to fix because these are software programs from blockchain companies. So clearly they know what they're doing. Clearly these aren't easy things to fix, but it really seems to be designed mostly just for trading. And if you're doing nodes, if you've got something on an L2, if you're doing play to earn, all that stuff, it just doesn't quite capture it correctly. So what we end up doing is you do the best you can, you get all of that information in there, but you still have to go through and redline the report to pick up the things that it missed.
I mean, it sounds like a nightmare. I mean, how much time are people spending on this in order to figure it all out?
there's not a lot of middle ground, at least from what we've seen. You either have the people who are really OCD about it, who are not only are they using the software, but for anything that's on a layer 2, they've got their spreadsheets and they've got this just honed down, and it takes a tremendous amount of time. Or you have sort of the crypto bro mentality of, oh, the IRS doesn't need to know anything. I'm not. You have the people who barely want to report the income to begin with, so they're very lax on what they're tracking and reporting. And if they are making adjustments, the documenting why they're making those adjustments to the reports. But to your point, if you're trying to do it accurately, it's one thing if you're just hodling. It's one thing if you don't have a lot of transactions, but if you've got any activity, like any volume of activity, it is astoundingly time consuming to do it correctly.
Well, because it's not out of one brokerage. You could be moving it into MetaMask, into something else, into a cold wallet, and you've got to keep track of all these things. It seems like it would be. It's not automated. It's not like the brokerages are doing it. It's like you said, you got to have a spreadsheet and you have to track every transaction, every receipt. I'll use a fiat term so everyone understands on each of these, and you got to keep track of them. And even just because you transfer it to MetaMask does not mean that you've sold it. So there's really no trends, but there's a fee. Sometimes,
so you're supposed to add that, keep track of your holding period, but add that to your cost basis. And one of the programs are trying to get better with it, but they really don't do a good job of recognizing transfers versus sales still. So a lot of times they're trying to identify, hey, based on your activity, you've sent a bunch of money to this wallet. We think we might be, you've given us 5 addresses. We think this might be your wallet. But largely, it still misidentifies it. And especially just for some of these slightly off the beaten path ones where people are doing barters or swaps, it does not recognize the flow chart of what's happening. And I think I've got a few clients who are doing a lot with one of the Radio Shack tokens. I think it was Atlas USV or something. But the way that would work is you'd sort of collateralize your token for 10 days and hold it, then you redeem it. And it would never pick up the cost basis. So this guy every 10 days was taking the same 5-10 grand or whatever it was, depositing it with them, then redeeming it, and every time he'd redeem it, it would think that it was just pure profit with no cost basis. So the initial report was just this insane amount of just straight profit that then you're having to go through and say, okay, well, that's what happened there, and then go and adjust it. That's the word. There's a lot of bad parts of crypto tax right now. That's probably, if not the worst part, it's the most arduous and time-consuming part.
What happens? There's laws around. Let's just use the fiat world, holding money in different countries, right? And so if you store your crypto in a foreign, let's say, exchange, how is that reported and how is that taxed if it never leaves the foreign exchange and you're only trading in that foreign exchange? How does that all work?
Right now, at least, I don't know that they've addressed foreign exchanges. They have addressed DeFi wallets. And the guidance they've said is that right now, for FBAR purposes, for the foreign bank account reporting, that crypto wallets do not qualify for foreign bank accounts. So you don't have to list them on your FBAR filing. That's not going to trigger, if you don't have other foreign bank accounts, it's not going to trigger an FBAR filing requirement. But they've sort of insinuated that, well, it might not be the worst thing in the world for you to do. If you want to be extra compliant, you can do it. And it's clear that that's the direction they're moving, or at least are hoping to move. Whether or not that's successful or not remains to be seen.
Okay. That's another nightmare that you'd have to add to it. Okay, let's get to tax strategies. So let's say you're a heavy day trader of crypto, what should they be doing in order to, be fair to the government, of course, but mitigate some of the tax issues that you've seen in crypto?
Yeah. The easiest thing to do is, and weirdly, you don't see a lot of people talking about this or doing it, but usually the way that the brokerage will default to, and if you're using CoinTrack or something like that, what they'll default to is FIFO, which is first in, first out. So when you're trading, it's always going to pull your earliest purchase of that token as what you're selling. So you bought some in 2020, 2021, 2022. It's always going to pull the 2020 first. Which there's advantages to that because you're more likely to qualify for long-term capital gains, which is a much more favorable tax rate. So for some investors, that's a solid approach. That's what you'd want to do. But if you're a day trader, you're just a high volume trader, you're very unlikely to hold something for a year anyway. So for those people, what we recommend is HIFO, which is highest in, first out. So it's always going to pull the highest cost basis of the token you're selling. We had one person, I think it was last year, we had someone who had quite a bit of trading, and I can't remember, they had like $600,000 worth of gains because this was 2021. They were doing, this was a 2021, not 2022.
I would say if he made it in 2022,
Yeah.
the brilliant
Right, he's a genius.
Get his name out, please.
Right. But anyway, that was from, I think he's using CoinLayer, CoinTracker, I can't remember which one. But you just went in and I said, I don't think you've got the right accounting method for this. So we went in and just changed the radio button from FIFO to HIFO, and it knocked him down like a good 150 to 200 grand in taxable gains.
Yeah, that's big.
So it depends on it. Most of these strategies very much depend on not only the bucket of activity of what you're doing. Are you mining, running nodes? Are you trading? Are you doing play to earn? And not only does it depend on your portfolio, but even within trading, it depends on what kind of a trader you are. It's just kind of, we have to look at the nature of your investment activity and then tailor the strategy around that. So for people who aren't long-term holders of tokens, because even if you do qualify for long-term capital gains, it's not always the best thing to do FIFO, because you could have it to where, you held some token for over a year, but you had $100 of cost basis versus a short-term capital gain you had $500 of cost basis. Even with the rate arbitrage and the benefit of having a lower tax rate on long-term capital gains, sometimes it still doesn't make sense because your absolute gain ends up being so much larger.
So is your recommendation to run an A/B test on FIFO versus HIFO to see which one benefits you the most? And do you have to keep that same methodology year after year?
Yeah, they want you to keep it consistent, and again, like anything that might change, and there's different things you could likely do, because one of the methods, you don't report the method to the IRS, and there's another method out there, but none of the programs do it because there's no ability to, called the specific ID method, which is, this happens with stocks as well. You can go in and specifically select which ones you're wanting to sell. None of the programs are capable of that because that's a manual decision. So they generally want you to keep it consistent, although that may change in the future. It ups your record keeping quite a lot if you were toggling back and forth, because you can't just do the radio button and it changes what you're pulling, which would make your prior year reporting very likely to be incorrect. There's a second part to that question, and I totally lost what it was.
Well, it's about deciding on what methodology.
Right. Well, that's the nice thing, is that because you are either required to be consistent, or it's a big pain to switch back and forth. So you want to think about your long-term strategy, not just what that year looks like, but it's really, in terms of A/B testing, it's really easy to do, at least for the first year you're doing it, because it's a setting that you're toggling within the program. You'll be able to see what it is on FIFO, and then go to HIFO, and it'll, within a minute or two, generate what the change in your gains were. So you can't just look at that and decide you can't use that as the only determining factor what that 1 year looks like. But if that year is consistent with the way you typically trade, then yeah, that's a pretty good starting point indication of what probably makes sense for you long term.
Okay. And anything else you could think of in terms of mitigating tax liability with crypto, or does it kind of mirror the fiat world in your experience?
A lot of it will mirror the fiat world. It really just depends on it largely depends on the not only again how you invest, but the buckets of income that you're. It depends on the project, is what I'll say, because one of the few pieces of guidance the IRS has given is that mining income is business income for U.S. income tax purposes. And business income is subject to self-employment tax, which is the employer and employee halves of Social Security and Medicare. So if you're, and they haven't issued explicit guidance on running a node, but from what we can tell, node income is most analogous to mining income. So that's our contention, is that it's taxed as mining income. So for those, it would make a lot of sense to set up an entity and have that running through the entity and have that taxed. Usually it's an S corp, occasionally it's a C corp, because you're bypassing that self-employment tax. So if you're mining or running a node and making decent profit, that can be a really good move. There's a few things. They're kind of overly specific examples to get into like the nitty gritty of it, but there are largely, you don't have a lot of control as to when you're claiming the income. Usually it's whenever the tokens are received, that's when you have to claim it. There are a handful of projects out there where you've got a little bit more control as to when you're claiming the income and when you have true, what they call dominion and control over the asset. So without getting too in the weeds of this project works this way and this is the reason, when that does exist, you have the ability either to accelerate your income or defer it. And normally, we're trying to defer income. Last thing I want to do is claim income and pay the tax earlier. There's a time value of money component. But especially for 2022, it's kind of interesting. We were, in a lot of cases, for those projects, telling people to go ahead and accelerate their income, take the hit early on, because when you run the numbers and look at when you ultimately dispose of the asset a year or two later, you end up saving a lot of money by taking the hit now, starting your holding period for long-term capital gains, stuff like that. It can weirdly, and you're already in a down year too. You're already in a year where the market is trash, so your overall income is probably lower and you've got a lower tax rate anyway. Mm-hmm. So that's something that's a little more case by case, but weirdly in the bear market especially, it can make sense to accelerate your income versus continuing to try to defer it the way we normally would.
Okay, so my last question has to deal with, okay, someone's just starting out. They want to obey the law, but they want to take advantage of any tax breaks for crypto, any way to mitigate tax liability. What should they do? How would you set them up to be successful in that regard?
It gets hard because it does get investor specific. It does depend on how much income are you earning.
Let's say they have a Coinbase account.
Yeah.
They have a foreign let's say centralized exchange, and then they use PancakeSwap and Uniswap and MetaMask.
Yeah, I mean generally the right accounting method is going to be a big part. This will seem really obvious, but do your tracking throughout the year. Don't wait until the end of the year, because.
But how do they do their tracking? On a spreadsheet?
Spreadsheet or using one of these programs. Generally, we'd recommend using CoinTracker or something. In that same vein, they're all basically the same, but something that's pulling all that in. Usually they've got APIs for these exchanges, or they're pulling from your public address. And it's going to pull
an API to Uniswap, though? Uniswap wouldn't have.
Uniswap it wouldn't do, but Uniswap, they're going to be able to pull that from Etherscan. So they'll be able to pull that from the block address. For the centralized exchanges, they've got an API. So that's going to pull the information in, and then you're categorizing it, and it's giving you an estimate. Here's what you're looking at so far this year. some of those programs will even say, hey, you've got tax loss harvesting opportunities available. And that's one of the things that probably should talk about, is that right now, at least, crypto isn't subject to the wash sale rule the way traditional securities are. I'm not sure if that's going to survive the 2023 tax year or not, but that makes tax loss harvesting a lot easier.
Just define tax loss harvesting for people like me that don't
Yeah.
know what you're talking about.
So, yeah. So if you've got, let's say you bought Bitcoin at $60,000 and now it's worth $20,000. So you've got a $40,000 loss, but it's an unrealized loss. So just holding it at a loss doesn't give you a tax deduction. But if you sell the token, then you can, with traditional securities, they've got the wash sale rule. So for traditional securities, if you sell your stock and the next day buy it back, you might have had that $40,000 loss, but the IRS is going to disallow that deduction, saying, hey, you bought it back the next day. You didn't really dispose of the asset, so we're not going to let you take this $40,000 loss on your tax return. With crypto, since it's not categorized as a security right now, it's not subject to that wash sale rule. So that Bitcoin that you lost $40,000 on, you can sell it and buy it back the same day, and you still trigger that loss for tax purposes.
Okay.
So that's another one of just the really easy strategies, and we that was one of the big things we were working with clients on before the end of the year, is looking at their portfolio, looking at where their biggest losers were, and executing those trades to realize the losses.
All right.
Because one of the things people will say is, well, capital losses, you're only able to use up to $3,000 to offset against ordinary income.
Per year.
So a lot of people say, well, man, that's only $3,000. That's not really, I only get to use $3,000 this year. What's the point? But those losses carry forward indefinitely.
Yes.
So it's another one of those strategies, kind of like accelerating your income, where it doesn't necessarily help you much this year. But if you do some planning and look at, okay, well, yeah, I didn't get to use much of the loss this year, but in 2023, I've got $100,000 worth of gains. Well, you've just got that loss banked there, just waiting to be used.
Yeah, it's a great point. I've seen that done, and it's very valuable to continue it year after year. Don't lose it.
Yeah.
All right. Is there anything before we wrapped up that we missed that you want people to know that's watching this? That's the first question. The second, I realize this is compound, is give us your information on how to contact you or your firm.
Yeah. So the biggest thing to do that we talk about, and again, this seems simple, but kind of goes with tracking throughout the year so you know what's going on, is as you have realized gains. So again, not unrealized gains where you bought Bitcoin at $1 and now it's worth 20 and you're just holding it, but you're actually doing trading, you've got staking income, you've got node income. As you're having realized taxable events, making sure that you're cashing out enough to cover the tax bill. And putting it in actual fiat, not putting it in a stable coin, because we saw horror stories of people who had seven figures in UST or even in USDC, but they were holding it on Celsius or Voyager or something like that. Because what we ran into a ton last year was people who had amazing 2021s and generated 6-7 figure tax bills from that, but they just kept reinvesting it back into the projects. So then the market tanks, and depending on exactly what you were investing in, your portfolio is down 50 to 99%. We've had people who came to us who had 6-figure tax bills, but their portfolio had dropped so much that they didn't even have the assets anymore to pay the tax bill. So that's not something that crypto zealots and people who are like true believers really want to hear, because they say, well, it's just going to go up. It's going to go up. And long term, it might. But if you're doing anything with these realized gains, you're almost required to cash out at least enough to cover the tax liability that exists. Because in the case of a lot of these people, they don't have a mechanism to pay the tax. They truly don't, because they were investing in some altcoin project that was mooning and then completely crashed, and they've got $1 million worth of taxable income in a portfolio that's worth 50 grand now. So that sounds basic, but just even if you love it, which most of us do, that's why we're in the space, at least make sure you're cashing out enough to cover the tax liability that's generating because of your investing.
Yeah.
So that's the main takeaway. It sounds stupidly simple, but it's most of the people
forget.
who are coming to us aren't doing that, and some of them just got. I mean, it could literally cause it will cause bankruptcy for some people. Not our clients so far, but there are going to be bankruptcies that trigger because of, and that's just a danger of a bull market followed by a bear market, especially given crypto's volatility. So that's the main thing. To the second part, if people are looking to reach out to us, they can go to cryptotaxcpa.com. And we also have a book that the digital version of it's free on Amazon called Decrypting Crypto Taxes.
Introduction. Crypto taxation is one of my absolute favorite parts of my CPA practice. There are few areas in accounting that can be as fascinating or dynamic. It is also one of the areas in which my team and I can provide the most value to our clients and save them the most money. But at the same time, it can often be one of the most confusing and frustrating areas in the entire world of taxes.
Every chapter is basically an FAQ on how is staking income taxed? How it was all the questions we got asked a lot. So every chapter is just kind of there as a desk reference for, hey, what do I do with this? And you're able to pull it and then put it back down because it's not particularly light reading.
Yeah, but it's important for those that really want to follow the law and to take advantage of every loophole or anything legal that they can. Okay, with that, Mike, I really appreciate you being on the show, and
Yeah, man. Thanks for having me.
Appreciate your insights, and do contact them if you have some issues with your crypto taxes. Obviously, last year was a huge bear market. Hopefully that turns around. So be prepared. Listen to what I asked the question. What should people do to be prepared? Make sure you take notes on that. With that, thanks again. If you've had the problems with banks and inflation and anything having to do with the US dollar or any currency around the world for that matter, you know how important crypto can be, but it's got to be the right crypto. So our friends at Tetragard have decided to create what's probably generally considered an ETF with 3 tokens, Bitcoin, Ethereum, and PaxG. They've wrapped it all up with a rewards token that's built in, and it's easy to buy. It's really quick at the website here. Now, the best part is you're getting rewards while owning this, and therefore you're making money just by holding on to it. How could you go wrong with this? Why would you buy Bitcoin, PaxG, or Ethereum separately when you can get them all wrapped together at the lowest prices with a rewards token built in? I can't think of a reason why. Can you?